Let's say you stand at the car dealership about to bag a new SUV with a car loan, but then the finance manager looks up at you and asks for your credit score. You start to feel an uneasy chill that slides down your spine because you've heard the rumor about credit scores out there. You hear things like holiday shopping might knock 50 points off overnight. The myths pile so high that credit feels like a folklore, not finance. It's time to clear the fog. Here's what banks truly weigh when your 3-digit number appears. A credit score is a 3-digit number, usually between 300 and 850. That sums up your past borrowing behavior so lenders can quickly gauge how likely you are to repay future debt. It's calculated from information in your credit reports, which are mainly payment history, amounts owed versus limits, length of credit history, the kinds of credit you use, and recent credit inquiries. A higher score signals lower risk to lenders, which can translate to easier approvals and better interest rates. The following are some popular myths about credit scores. Number 1. Checking my credit score lowers my credit score. This is in fact not true. Though 93% of millennials are aware of their credit score, this is probably the most common myth. Monitoring your credit score helps you track progress when you build credit, but it's important to check it right away. When you check your credit score yourself, it's considered a soft pull, which doesn't affect your score. However, when you apply for credit, like a credit card or loan, a hard pull is triggered, which can temporarily lower your score. If you're checking your score through legitimate sources like credit bureaus or approved apps, it won't hurt you. On the other hand, if someone else like a car dealer or mortgage broker pulls it, especially as a favor, it could count as a hard inquiry and potentially lower your score. Number 2. Carrying a balance on my credit card boosts my credit score. This is also not true. Carrying a balance doesn't help your credit score. It only risks harming it and costs you money through interest payments. A lingering balance increases your credit utilization rate, the percentage of available credit you're using. The higher your utilization, the more likely your score will drop. If you can afford it, it's best to pay off your balance in full every month. Number 3. My income impacts my credit score. This is not true. Your salary or income isn't listed on your credit report and doesn't directly affect your score. Credit scores are based on risk factors, how you've managed credit in the past, not how much money you make. Instead, your score is influenced by your payment history, how much you owe, credit utilization, length of credit history, new credit, and credit mix. Number 4. A good credit score means you're rich. This is also false. A good credit score simply means you're considered a responsible borrower. It doesn't reflect how much money you have in the bank or how high your salary is. Even someone with a modest income can have excellent credit if they pay their bills on time and manage credit wisely. Number 5. A perfect credit score doesn't really matter. This is in fact true. While hitting a perfect 850 credit score might feel impressive, there are no special perks beyond a certain point. Once you reach a score of around 760 or above, you typically qualify for the best rates and terms available. So while it's nice to aim high, there's no practical difference between an 800 and an 850 in most lending situations. Paying off debt increases your credit score. This one can be true and false. Paying off credit card debt generally improves your score because it lowers your credit utilization. However, paying off installment loans like auto loans or student loans doesn't always lead to a higher score. In some cases, closing an account by fully repaying a loan can slightly lower your score because it reduces your active credit mix. Let's take a look at the elements of a credit score. Number 1. Payment history. This includes records of every on-time, late, or missed payment that shows on your reports. A recent 90-day delinquency hurts far more than one from 3 years ago because recency signals ongoing risk, not distant regret. Number 2. Amounts owed, credit utilization. This record compares balances to total limits on revolving lines. Balances above 30% hint at a strain, while balances under 10% signal control. Like keeping a fuel gauge above half so you can handle a detour. Number 3. Length of credit history. This record considers age of your oldest account and average age across all accounts. A 10-year track record tells a richer story than a 10-month history. Number 4. Credit mix. This record looks at a variety of installment loans, revolving lines, and possibly a personal line of credit. Managing different debt types shows broader money skills. Number 5. New credit inquiries. This record counts recent hard pulls and new accounts. Several inquiries packed into a short span can resemble a frantic cash hunt, even when the goal is simply chasing travel rewards. So even an 800 score is only part of the approval puzzle. The bank also reviews the following: debt-to-income ratio, or DTI. They total monthly obligations, then divide by gross income. Most conventional mortgages cap DTI at 43%. Auto lenders often prefer mid-30s. A strong score cannot mask a payment already spoken for. Cash reserves. Savings equal to at least 2 months of payments reassure the bank that you can absorb a job loss or medical bill without falling behind. Employment stability. 2 years in the same role or industry suggest reliable income. Frequent job changes raise questions even when each hop came with a raise. Collateral quality. For secured loans, the asset matters. A condo in a stalled development or a 16-year-old truck offers weaker recovery value if you default. Derogatory marks. Charge-offs, collections, and bankruptcies carry more gravity than the raw scoreline. Lenders verify dates, amounts, and proof of settlement. Score trend. Modern models chart direction. A steady rise over 6 months hints at discipline. A steady slide suggests brewing risk. So, it's not impossible to build up a healthy credit score now. There are steps you can take to get that confidence level you need when approaching a bank loan. They include the following: automate payments. Schedule at least the minimum on each account to eliminate forgotten due dates. Pay mid-cycle. If balances climb, send an extra payment before the statement closes to keep utilization low. Request limit increases wisely. Ask once income rises or balances fall. The single hard inquiry usually costs fewer than 5 points and often reverses within 90 days. Keep the oldest line active. Charge a small recurring bill quarterly and pay it off to prevent closure. Space out new credit. Aim for 6 months between applications. When rate shopping for auto loans or mortgages, pull quotes within a 14-day window so multiple inquiries count as one. Review reports 3 times a year. Pull one bureau every 4 months. Dispute errors quickly, and follow up until corrections post. Add variety with intent. A low-fee secured loan or credit builder account can round out an all-card profile without risking large debt. Build an emergency fund. Even 1 month of expenses in cash can stop a crisis from turning into late payments. Underwriters notice reserves. Prepare 6 months before major loans. Pay down balances, avoid new accounts, and let your report age quietly. Let's take a look at the 6-month rebuild roadmap. Month number 1. Pull your reports, list every open account, note limits, balances, due dates, and interest rates. Set auto payments for minimums. Pay down any card above 50% utilization first because scores penalize heavily at that threshold. Month number 2. Ask long-standing card issuers for limit increases. Even a $500 bump can drop utilization by several percentage points. Month number 3. Apply for a credit builder loan if your file is thin or lacks installment history. Make payments on time and keep card balances under 30% while this new account seasons. Month number 4. Schedule bi-weekly extra payments to cut high-interest balances faster. The smaller, more frequent hits also lower reported balances mid-cycle. Month number 5. Check reports again. Confirm higher limits reported and verify no late marks appeared. Dispute any inaccuracies. Month number 6. Pause new moves so your application for that loan or mortgage shows 6 months of calm, low utilization data. A credit score, as we've seen, is not magic. It's a mathematical summary of payment habits, balance management, account age, variety, and recent inquiries. One signal among several that banks weigh against income, debt, savings, and job stability. When rumors swirl about zero debt helping credit scores, remember the real rules. Pay on time, keep balances modest, allow accounts to age, add new credit slowly, and limit hard pulls. Stay informed and treat your credit profile as a living financial asset that grows with steady care. Have you heard a stranger myth? Share it in the comments and hit subscribe for more clear-cut guides that keep money in your pocket.